Lately, S-REITs have been gaining a lot of attention, and today we're going to explore this exciting asset class. We'll guide you through some of the key concepts and strategies for investing in S-REITs. These are the topics that I'll be covering in this video. Firstly, what are S-REITs? Why invest in S-REITs? With a spotlight comparison of S-REITs versus physical properties. When is a good time to invest in S-REITs? And finally, how to invest in S-REITs? So what exactly are S-REITs? Many of you are probably familiar with real estate here in Singapore, but perhaps less so with real estate investment trusts, or REITs for short. Let me give you a quick overview. Think of a REIT as a mutual fund. A REIT manages pools of money from investors. But instead of investing in stocks or bonds, a REIT primarily invests in income-generating real estate. And this can include a variety of commercial properties such as office building, shopping malls, warehouses, hospitals, and even data centers. Investing in REITs is like owning a small piece of these properties without having to buy the whole property yourself. REITs listed in Singapore are referred to as S-REITs. And as of August 2024, there are 40 S-REITs listed on SGX with a total market capitalization of around $100 billion. And this makes SGX one of Asia's largest REIT and property trust markets. Why should you as an investor be interested in real estate, whether through physical properties or REITs? And it boils down to two main reasons. Firstly, capital appreciation. And you want the value of your investment to grow over time. The second reason, rental income. You want a steady stream of income from tenants renting the property. And as a REIT investor, you own units in the trust, and the net asset value of each unit increases as the value of the underlying properties appreciate. Plus, you also receive a share of the rental income generated by these properties. And in Singapore, S-REITs are required to distribute at least 90% of their taxable income to investors, which is why S-REITs offer attractive distribution yields. A blue-chip S-REIT typically offers a yield of 5 to 6% per annum, with some providing even higher yields. Compared to owning a physical property yourself, S-REITs have several advantages. And one major advantage of S-REITs is their tax-efficient structure thanks to the tax transparency framework provided by IRAS. Unlike regular companies, S-REITs are exempt from corporate tax if they distribute at least 90% of their taxable income annually. Additionally, individual investors don't have to pay dividend tax or income tax on these distributions. On the other hand, rental income from physical properties is subject to income tax. So this tax-efficient structure makes S-REITs a very attractive option for building your passive income over the long term. Also, S-REITs have a very low capital requirement. With a minimum of 100 shares on the SGX, you can start investing in S-REITs with just a few hundred Singapore dollars. On the other hand, buying into physical properties require high capital outlay in Singapore, which is often a few $100,000. S-REITs are also highly liquid. Because they are listed on SGX, you can trade them with ease, just like stocks. In addition, S-REITs provide diversification by investing in multiple properties across different countries, and you can also diversify even further by holding several REITs. Lastly, S-REITs are professionally managed, so you don't have to worry about tenancy, leasing, or financing, unlike hands-on work required in managing physical properties. Of course, there are also advantages to owning physical properties. For example, you have more control over the property. That also comes with higher maintenance or management fees and can be quite time-consuming. You can also use leverage through mortgages to potentially boost potential returns. For many investors, especially those starting out, S-REITs does offer a less risky and a more accessible way to tap into the real estate market in Singapore. When is a good time to invest in S-REITs? And to answer this question, let's take a look at the key drivers for S-REITs performances. At the broad asset class level, there are two key macroeconomic drivers: economic growth and interest rates. Let's talk about economic growth first. A strong economy usually means higher demand for commercial real estate. And this can boost rental income and property values for REITs, which is great news for investors as it can lead to higher dividends and also higher capital appreciation. On the flip side, a weaker economy can have a negative impact on REIT performance. And moving on to the next key driver of REIT performance, the interest rates. REITs are sensitive to interest rate changes for three key reasons. S-REITs often use debt to finance their operations. Hence, when the interest rates are lower, their borrowing costs decrease, which can lead to improved profitability. Secondly, investor sentiment. Lower interest rates can make cash instruments like T-bills and fixed deposits less appealing due to lower yields. This can cause investors to shift their money into REITs, increasing demand and potentially driving up prices. And lastly, property valuation. Interest rates play a very key role in how properties are valued. Lower rates generally lead to higher valuations for the underlying properties, which can benefit the REIT holders. So in a nutshell, lower interest rates tend to be more favorable for REITs, while the inverse can potentially hinder their performance. So is now the right time to invest in S-REITs? In July 2024, Syfe held an S-REIT mid-year outlook with SGX and Lion Global investors, which we will link in the description below. But to quickly recap why Syfe is optimistic about the sector, the global economy is projected to grow at a steady 3.2% in 2024 and 3.3% in 2025 according to the IMF. Singapore also shows stable growth. The median forecast from 21 economists surveyed by MAS in September indicates that the economy is expected to grow by 2.6% in 2024 and 2.5% in 2025. This stable economic environment is very conducive for S-REITs. Secondly, favorable interest rate outlook. The Fed initiated a 50 basis interest rate cut in September, signaling the start of a rate cutting cycle. This will remove key headwinds faced by the S-REIT sector for the past 3 years. Despite the recent rebound, S-REITs valuation remain compelling. They are currently trading at an average of 0.95 price-to-book ratio, which is lower than the historical average of 1 and significantly lower than the 1.2 to 1.4 seen before the COVID-19 pandemic. And this could suggest that there's still room for attractive returns. But even beyond these immediate tailwinds, it's important to consider the long-term potential of S-REITs. Since the end of 2010, S-REITs have returned 149%, while Singapore equities, as gauged by the Straits Times Index, returned 89% over the same period. And this shows that adding S-REITs into your portfolio can help to grow your investment steadily with both income and capital gains working for you. So how can you invest in S-REITs? There are several ways. You can buy individual REITs through a brokerage, you can invest in REIT ETFs or funds, or you can consider Syfe's REIT Plus portfolio, which offers optimizations like auto reinvestment and no brokerage fees. Let me go through the pros and cons of each approach. Firstly, investing in individual REITs gives you more control and allows you to pick the ones that you are most confident in. You can potentially get higher returns if you choose wisely. However, selecting the right REITs requires significant research effort. Here is a snapshot of a framework of some common metrics used to evaluate REITs. In addition to quantitative measures related to financial health and valuations, qualitative evaluations of the underlying REITs, the sponsors and the managers are also necessary. I won't delve into each parameter in detail, but you can see that the commitment and the time required are substantial. And even after conducting thorough analysis, outperforming the overall S-REITs market is not guaranteed, and you'll also incur brokerage costs, and the dividends aren't automatically reinvested. Another way to get exposure is through S-REITs ETFs, and some of the ETFs are Singapore-focused, such as the Lion Philippe S-REIT ETF, while some have exposure to Asia Pacific, such as the Nikko AM Straits Trading Asia ex-Japan REIT ETF. REIT ETFs give you instant diversification and lower volatility, but you give up control and you still need to pay management fees and brokerage costs. And finally, there's Syfe REIT Plus portfolio, one of our flagship managed portfolios. Our REIT Plus portfolio tracks the SGX IH REIT Leaders Index, which focuses more on the blue chip S-REITs. We partner with SGX to launch this portfolio, making it the first to track this specific index. And through this portfolio, you get exposure to the top 20 well-known and liquid SGD-denominated S-REITs, with added efficiencies like automated dividend reinvestment and enhancing long-term returns. There is an overall management fee starting from 0.25% per annum, But Syfe covers all other transaction and brokerage fees, and there are also no hidden charges. What I like to emphasize is this: instead of fully replicating the IHS REITs Leaders Index, we use an optimization process to construct our index tracking portfolio. And since its inception in April 2020, Syfe's REIT Plus portfolio has consistently outperformed the benchmark almost every year, with an impressive cumulative outperformance of 5.5%. We will link our REIT Plus portfolio in the video description as well. While S-REITs tend to be less volatile than stocks, they are still subject to market fluctuations and are sensitive to interest rate changes. When allocating to S-REITs, it's essential to view your investments from a total portfolio perspective to ensure proper risk management. If you have any questions on how S-REITs can fit into your portfolio allocations, do reach out to the advisory team. We'll be glad to share with you more. Thank you.